Welcome, everybody. My name is Jeff Fowler, president of the Apartment Owners Association. It is just great to have you with us today. Blue skies here. And man, we had a tremendous time at the Bay Area Landlording Power Conference that we held yesterday. And over 300 people showed up and 6 different speakers. And so many people came up thanking me for just the great content and everything that they learned. And so it was just such a great time to connect with members there in the Bay Area. And anyway, today we're going to have a market update. So this will be great. And so stay tuned for that. But before we get started with that, just want to say that AOA is dedicated to your real estate success. We're in your corner, and we have the forums that will help you, and the tenant screening. We have property management software, all kinds of the helpline that you can call. So all these things, we're in your corner, and we want to help you just do the very best you can possibly do, maximize your investments. And that property management software specifically really streamlines things. If you're looking to go online with your rental payments, or just have everything in one place, then it could be a really good solution for you. It does link up with your AOA member account. So if you're use the online rental application, then that information can be sent to your member account to do the screening. And anyway, so that's just one thing I wanted to highlight about AOA with you today. And then also one thing that came up this week, a lot of you probably know about it already. On Tuesday, Supreme Court decided not to take a couple of the cases from New York City that were regarding their rent control ordinance. And so that's not good. So often I get the question, well, this just seems like a taking. They're over controlling everything. And yes, that's true. And I think the Supreme Court Justice Clarence Thomas, he said, hey, if you bring this in the right way, that we could look at this. And so we'll see what constitutional attorneys put together in the future. And hopefully there'll be a case that is heard, and hopefully we can regain some of our property rights. And so that's just an update that I wanted to share with you. Next week, we're going to be covering habitability lawsuits and how to avoid them. So there'll be an attorney that speaks about that next week. So hope you're able to make it. And March, I want you to just check the seminar calendar on AOAUSA.com. But March 14th, we have a conflict resolution for property managers or rental property owners. That's going to be in San Diego on the 14th. In Fremont on the 26th, there's a 12 Pillars of Property Management course. That's free. All these are free for members, of course. And then on the 28th, we're going to have a doubleheader in Oakland. And Mike Shepard, incredible attorney, will be sharing about just the understanding the eviction process. A lot of the same seminars that we had this month here in Southern California. And then, of course, on March 20th, we have the AOA $1 Million Trade Show and Landlording Conference. And so that one will be just amazing. There'll be at least 150 vendors there. We'll have, I believe, it's definitely over 20 seminars that will take place in that one day. And it's just a great day to come, get your axe sharpened, get encouraged by seeing other people that are in the same position that you are. And anyway, so definitely want to encourage you to come to that. And even if you're not a member, you actually get a free 6-month membership if you go and you've never been an AOA member before. So that is all coming up. And for this live stream, there is a blue, if you're watching from AOAUSA.com, there's a blue help button or circle at the bottom right side of the page. In there, you can type your questions. But let's hear the market report, and then we can take questions afterwards. And so this event, it's sponsored by Real Estate Transition Solutions. So shout out to them. and they're a real estate investment advisory firm. They specialize in DSTs. They have 3 offices on the West Coast. They're licensed in all 50 states and 220 million yearly in replacement properties. And that number can go up and down, but I think that's where we're at today. And our speaker is a partner at Real Estate Transition Solutions. He's in charge of operations, marketing, education. He's been with the company for 6.5 years. He grew up in the industry. His dad's a real estate investor. And he started off, graduated, became a CPA, worked with PricewaterhouseCoopers. And anyway, I'll let him share more about that. And I'm really excited to hear about I'm just really curious to see his take on the current market. So it's my pleasure to introduce to all of you today, Austin Bowlin.
Jeff, I appreciate the introduction there, and thank you for all the good work that you and the whole team over at AOA do in terms of keeping investment property owners informed and then also advocating on their behalf from a legislative and regulatory standpoint. Without question, the environment would be a lot more difficult than it already is if organizations like AOA were not out there fighting the good fight. So as Jeff mentioned, my name is Austin Bowen. I'm a partner here at Real Estate Transition Solutions, headquartered up in Seattle, Washington, with offices throughout the West Coast. And today we're going to be talking about 2024 market outlook for investment property owners. So quick overview of what we'll be discussing today. We're going to open it up with some macroeconomic conditions, look at some specific property types themselves, locations that are attractive from a replacement property standpoint for those of you who are looking to perhaps invest in markets outside of California. We'll do a quick survey of the tax and regulatory landscape from a federal standpoint, and then distill it down into some takeaways and make sure to save some time for Q&A at the end as well. One of the replacement property options that our firm works extensively with is what's referred to as a Delaware Statutory Trust, or DSTs. In order to invest in DSTs, which is not the focus of today's presentation, but is the lens through which we look at due diligence and why we have such a robust due diligence function in-house. But DSTs do require investors to be what is considered accredited. Typically, that means net worth in excess of $1 million, not including the value of one's primary residence. So as Jeff mentioned, our firm's a real estate advisory firm. We focus on serving property owners who are navigating the transition from what we consider to be the third to the fourth quarter of property ownership. This is a period of time in life in which a lot of owners are looking at their real estate that they own today, whether that's a single family rental or rental condo or larger multifamily properties, and saying, this property may not fit in line with my objectives any longer. However, if I were to sell the property, I'd face significant tax consequences. And while I know that I have 1031 exchanges available to me as an option, I don't really want to trade apples for apples or buy another property that I'm going to have to actively manage or oversee third-party property management on. So that's where our firm comes in. We specialize in fractional ownership of institutional properties. And what I mean by that is effectively the ability to sell whatever investment property you may own and take all or a portion of the proceeds in exchange into owning a percentage of substantially larger institutional properties that are passive from an investor's standpoint and have a number of other benefits associated with them. The due diligence function that our firm has built up over the 20 years in which we've operated in this space is something that gives us a lot of visibility into macroeconomic trends, nuances among respective property types and what's happening with those property types at any given moment, as well as markets around the country and where we see the best opportunity lying. Quick snapshot of some of the key individuals on our team here. So the firm was founded by my father, Roger Bowlin, just over 20 years ago. I joined the firm back in 2016, coming up on 8 years now, and I'm a CPA by background, as Jeff had mentioned. You can see Joe Duckett, our Chief Marketing and Education Officer, Monica Parikh leads our due diligence team, a few of our exchange advisors, and Kimberly Frohart, who leads our client services investor relations team. When we talk about 1031 exchanges, most property owners at this point are familiar with the fact that an exchange allows the tax that would otherwise be due upon the sale to be deferred as long as replacement property is acquired. But when we look at the motivations as to why someone would contemplate a sale and exchange, there's a number of components that need to be looked at, both in terms of the property that you may own today, what would be referred to as the relinquished property if you were to sell and exchange it, and then the opportunities that you have for replacement property to invest in. And in that decision to sell a property, largely people are looking at values. Is there a large enough gain associated with a potential sale that it's going to warrant a tax deferral strategy like an exchange? And as I'm sure everyone knows, California has the highest state income tax in the country. So the tax that's due upon the sale of a property in California can be substantially more than the tax that would be due on a sale elsewhere. We're looking at the economic conditions, and that can be at the national level. It can also be at the local market level. And economic conditions are very much dynamic from the standpoint of they're changing on a regular basis, and trends that we may see play out over multiple years and decades are not always going to be the way in which things are. For instance, there's been net migration into the state of California, leading to population growth for something like the last 35 to 50 years, all the way up until 2020. And then we've now seen 4 years since 2020, where there's been an actual outward migration. Is that going to be the new trend moving forward, that California's population is going to be declining? Probably not, but it may be for the foreseeable future. And I think most economists at this point are saying that they expect 2020 and 2030 populations to ultimately be the same in California. Regulatory condition and outlook. Is the regulatory environment improving at the local level, at the municipal level, the county level, and the state level? Or is it just getting harder and harder and harder? And it seems like the faucet only turns one direction there, of new regulation being introduced and ultimately implemented, without regulation that ultimately is determined to not be effective being repealed. So many property owners are looking at, how do I get out from underneath that environment and put my investments at risk, my assets at risk, by operating and managing in that environment? And where are there opportunities where there's a much more reasonable approach? When we look at replacement properties, given that Section 1031 of the tax code enables you to exchange into any domestic location among any property type, provided it's held for business or investment purposes, now we can consider all the factors that you see listed here to ultimately design an exchange strategy that is going to move a property owner toward accomplishing their objectives. The big picture macroeconomic trends that are top of mind for most individuals and are impacting the property values and investment decisions in today's environment are going to be, first and foremost, inflation. Inflation has come down considerably since the peak levels that we saw at the tail end of 2022, which is positive. However, now inflation's focused on, not so much because it's such a large number, but instead, where does inflation need to settle or land in order to then see bullet point 2, movement on interest rates? So as most of you probably know, the Fed increased interest rates dramatically throughout 2022 and into 2023. The last rate increase that they put forward was in the middle of 2023, in July of 2023. And now rates have held fairly stable since then. The Fed's rate itself hasn't changed. However, we do see still fluctuation in treasuries and other benchmarks, because those who are trading on and buying those investments are saying, do we expect rates to come down or go up in the future? And what's the timeline associated with that? But we are in a much more stable interest rate environment now than we were a year ago, without a question. And is there going to be a potential recession? Well, I think that the general consensus is the likelihood of there being a recession in the next 12 months has declined significantly. However, that doesn't mean it's not possible. And additionally, it doesn't mean that we're necessarily going to have the growth that we were accustomed to seeing throughout, say, the 2019s. And then where's the stock market line and what other investment options are available? And what's the risk profile and pricing of those investment options? Because right now we're seeing a lot of indicators that are pointing in multiple different directions. S&P's at an all-time high. Bonds have been suffering recently, but for a while those two were trending together, which is not something that we commonly see. Within the impact of real estate that these macroeconomic factors had, ultimately what it translated to, if we were to look out at the last year and what our expectation is for the coming year, is property values were impacted significantly as a result of the increase in interest rates, coupled with the inflation that put pricing pressure on operating expenses, coupled with the fact that because rates were so low in 2001 or 2021, 2022, we saw significant amount of new development begin for many properties and supply in new markets. Additionally, investment volume declined. And depending on what property type you're going to look at and what size property, it'll give you a feel for how much it declined. But on the whole, across the board, we're looking at typically somewhere between a 50 to 65%, not decline in property value, but transaction volume of respective property types. So what are we looking at in terms of the impact on values over the previous years, and then what do we expect moving forward? Well, what you'll see in the property types that we focus primarily on, which are really going to be multifamily, industrial, storage, some medical office, and senior housing, student housing, and net lease retail. The decline in values that were experienced throughout 2023 and 2024 were not so much a decline in value in the true sense of the word over a multi-year period. In some regards, it was a give back of the very rampant appreciation that you see in 2021 and 2020 or through early 2022 as a result of those interest rate declines. And the year over year, call it growth trajectory or increase in value, if you look over a, say, 5-year period, going back to 2019 or longer, is actually quite strong for these respective property types. But what I want to focus on more specifically is there's 1 month's worth of 2024 data included within this chart here. And what you'll see is finally some stability. But stability, if you look at this chart over the last 7 years, doesn't often last long. These property values are moving all the time. And they're moving because of interest rates, because of inflation, because of demand drivers, because of macroeconomic conditions. But that stability often will translate to increased transaction volume. And there's a lot of buyers right now in the market with cash that are just waiting for opportunities and ready to pounce. And when they see rates starting to come down, at that point, there will already be momentum up on property values. And I think if you're a potential exchanger, if you're asking what the implications are for making the decision as to whether I should sell my property and exchange into a different property, I don't know that market conditions honestly matter that much to you because you're going to stay invested in real estate. And of course, we can reposition from what may be considered an overvalued market or an overvalued property type to where there's more opportunity. But one of the often unheralded benefits of a 1031 exchange is the fact that it keeps you invested in the market over a long duration of time by continuing to own investment real estate. And that's where we start to get those normalized 5-10 year average rates of return. I do think there's going to be a lot more buyer appetite for properties this year. I do think we'll start to see appreciation, meaningful appreciation in properties probably toward the latter part of the year. But if you sell in an exchange, that means you're buying into that market too. So you benefit from the appreciation on the sale, but you're also paying for that appreciation on the purchase. So really it comes down to then your specific set of objectives in your profile, not so much timing the market, but when you want to sell in order to address your, say, ability to step back from management or reduce your exposure to the regulatory environment or have diversification and so on and so forth. Each property type itself has different nuances associated with it. And in turn, from our standpoint, a different due diligence process that it needs to go through. But it's important to recognize that not all these property types are impacted by these macroeconomic trends that we're discussing in the same way. A lot of people ask us, well, what are you seeing in terms of popular replacement property options? And often that question's targeting the Delaware statutory trust structure. What have people been exchanging into? This shows a snapshot of trailing 12 months from as of end of November, the breakdown in terms of property types that individuals have exchanged into DSTs. So in aggregate, I think this represents just over, say, $4.5 billion of equity invested into Delaware statutory trust replacement properties. And there's two clear winners in terms of the volume of exchange equity, multifamily and industrial. And I think a lot of people prefer those property types in part because they're very different from one another and they can complement one another effectively. In one hand, you have short duration lease properties with the ability to actively add value to those properties and improve management effectiveness and efficiency, but capture organic and inflationary rent growth. On the other hand, you have long-term net lease properties in the industrial classification with typically fairly high replacement costs given the concrete and steel, stability of the tenant, stability in the supply chain, not as susceptible to e-commerce actually benefiting from it. Both can have supply-demand considerations that we need to look at on the local market. But two property types that are very different from one another but pair well together, and then a fairly broad spread of different property types in which individuals will also integrate into their replacement property portfolios. One interesting metric here is the concept of a capitalization rate, how that impacts a property value, and where we're seeing current cap rates as of year-end 2023. So as it stands right now, the multifamily properties are at about a 5.8 cap without a significant year-over-year change. Industrial is looking at 5.1, and that cap rate's increased, meaning property values relative to the income being produced have been declining over the previous period. Same with office, storage, senior housing, and all really but multifamily and single-family rental property and multi-tenant retail have been adversely impacted from a valuation standpoint over the previous year. Markets that we favor and really try to focus on to the extent possible from a reinvestment standpoint are markets that have strong demographic trends, that have a favorable regulatory environment, that are pro-business, that have a diversification of the employment base for properties that's critical for, like multifamily, like built for rent, single family, arguably even like senior housing and student housing, although less focused there on the actual area employers and the growth prospects of those employers. Infrastructure, taxation, all of which needs to be considered. And where we're seeing people move throughout the country as continued migration that in large part was sparked by COVID starting 4 years ago, but has continued to carry forward in various trends, is that there is outward migration from states that have either had a poor COVID response, high taxation, are deemed to not be considered safe or well-managed states, and are losing economic opportunity in part because of high cost of living. And where people are electing to move toward is where they see that policy approach where people are intentional about safety, they're intentional about supporting businesses. House cost of living is not that high, and employers recognize that people want to live there. So they're expanding their presence, their offices, their operations in those markets, and then welcoming people moving to those markets. What we have here is just a quick breakdown by market as it relates to individual property types. So just a snapshot here. I'm not going to dive too deep into this, but I am going to note an element of when we talk about multifamily operating income, I think that this is going to be applicable whether we're talking about a property in Boston or Los Angeles or Austin, Texas. Most properties right now, barring a few markets in the Midwest, are not experiencing meaningful year-over-year rental growth. And the reason why that's the case is because, as I mentioned before, when interest rates were low, it was very much feasible to build significant amounts of new units and deliver those units to the markets. And that's created excess supply. Now, fortunately, the demand statistics, absorption rate specifically, based off demographic trends and then the number of units being leased up, have been strong. And so while we may see 5, 10, 15,000 new units being listed, or excuse me, delivered in markets, which are historic highs in many markets right now, they're also looking at historically high absorption rates. So that means it's just a matter of time before that new supply ultimately gets completely absorbed, and then rental growth should reoccur and resume. Simultaneous to this, though, while rental growth is not increasing at the rate that it historically has, operating expenses have increased dramatically year over year. I'm sure every property owner joining us today has been surprised by either their property tax assessment in some situations, or as California owners, more likely their property insurance bill. I mean, we're seeing property insurance bills that are sometimes 3 times what they were the previous year, and no one predicted that. So I do think that there's going to be income pressure on many of these properties right now. That could create forced sales if someone has excessive debt on their property or variable rate debt as well. But it is a short-term, call it work through, because what we're seeing from a core fundamental standpoint is even these markets that have had significant supply delivered into them, like Austin, Texas, that absorption rate is strong. The economy in that market is strong. There is very little new construction anticipated to be delivered after 2025. And then we should see that resumption of meaningful rental growth and net operating income growth after that point. Markets that we look at from an industrial standpoint, completely different than multifamily. Here we're focused on logistics, networks, we're proximity to ports, both seaports, land ports, etc., interstate access, rail lines, drive time to major commerce centers. But there's a number of markets that we focus on within industrial. And we're not so concerned about population here, but more proximity to large population centers. Now, there has been a significant amount of development in the industrial space as well. And many people are saying we're starting to approach an oversupply environment there. That very much depends on what type of industrial we're speaking to, the size of the building, the style of construction. And the large fulfillment centers are where we're probably seeing the largest indication of excess supply. But in smaller flex space, sub 50,000 square foot buildings, that's where we still see a lot of opportunity for small businesses, medium-sized businesses, smaller users and not much by way of new development within that property profile. And then retail is like hospitality, absolutely having its moment right now in this, and that's a good thing. A lot of people assume that e-commerce is just eating brick and mortar retail's lunch and that there will never be a return to shopping in person, but the data does not support that assertion one bit. We're seeing a lot of the large retailers now actually leveraging their brick and mortar locations, as we'll call it, quasi mini fulfillment centers, especially with online order and the in-store pickup options or walking it out to your car. And as you're running errands, you can get a product within 90 minutes and have someone just walk it straight out to you. I mean, that's a very compelling proposition. And we know there is always a place for brick and mortar. I mean, if anyone could have made the pure e-commerce and logistics work for various product categories, it would have been Amazon. Yet in 2012, Amazon needed to, or 2014, purchase Whole Foods and very much leverage Whole Foods to give that breadth of options. You can come and shop in person, you can pick up at store, or they can deliver directly to you. Now, from a tax and legal reform standpoint, a couple of key items worth noting here to have on everyone's radar. First is that for investment property owners, there are some critical and key provisions in the Tax Cuts and Jobs Act of 2017 that was passed by President Trump that benefited you all from a tax standpoint. And there were some components that also adversely impacted you, given that you're California residents and are a higher income tax state. So the first is that state and local tax deduction limitation. You recall at the IRS federal level, the maximum deduction was limited to $10,000. So for someone paying $50,000 of property tax or a certain amount of state income tax, they're no longer able to deduct all of that, but instead up to $10,000. If that limitation ends up expiring in 2025, as all of these provisions are currently scheduled to, you'll probably see a momentary increase in, say, for instance, California property values, because now from a net tax standpoint, you're not being penalized by having high state income taxes. Mortgage interest deduction limitation, currently that's capped at $750,000 mortgage balance. That could get carried into being potentially unlimited, although we doubt that we'll see that be the case. And then the qualified business income deduction. This is big for people who own real estate and own operating entities that are small, medium-sized businesses in pass-through entities. This is a 20% blanket deduction with some phase-outs and some asset test methodologies to get an exemption to the phase-out, but is a significant part of the Tax Cuts and Jobs Act. And then lastly, bonus depreciation. There's been a recent proposal to bring back 100% bonus depreciation, but as it stands today, this year, we're at 60% bonus depreciation, not 100%. And that is also scheduled to expire in 2025. We do think we'll see some tax legislation following this election cycle. I mean, you'll hear this talked about plenty over the coming year. Then in March of 2023, which is almost a year ago now, the White House put a budget proposal forward that ultimately very few of those proposals were accepted. It was not passed, but it does give us a glimpse as we enter into the campaign season for the 2024 presidential election and congressional elections. What we'll probably see be talked about on the Democratic Party side in terms of proposals. That White House budget proposal included an increase of the net investment income tax for individual taxpayers making over $400,000. So that's a 3.8% tax currently. It's applicable to all asset sales, all rental income, all dividend income. And they were talking about bumping that up from 3.8% to 5%. They're looking at taxing capital gains instead of at either 15 or for most 20%, instead taxing at ordinary income tax rates, which can be as high as 37% as the brackets stand today. So that was part of the proposal. And then also limiting the amount of gain that can be deferred via a 1031 exchange to 500,000 per individual, $1 million for a married couple per year. And then lastly, the removal of a step up in basis concept for those that have total estate values of over $5 million per individual. That would be a fundamental change to the estate planning tax code and how we treat taxation of estate matters. There was discussion of limiting the 1031 exchange within that March proposal. Currently, there's no active conversation. We do not expect there to be changes made to Section 1031 of the tax code. And again, those were all proposals. None of that is in place at this point. Status of eviction ban moratoriums. Interestingly, in most municipalities around the country, eviction ban moratoriums have expired, at least those that were related to COVID. I know in Seattle and certain California municipalities, there's still wintertime eviction ban moratoriums or school year eviction ban moratoriums. But for the most part, the COVID moratoriums have expired. However, while they've expired from a legislative standpoint, they don't feel like they've expired for property owners because now the courts are so backed up in terms of processing evictions that while you legally can pursue an eviction, in practice, you actually can't work through one, not within a reasonable period of time. So that's a really unfortunate dynamic that we're seeing in some places that are requiring legal representation paid for by the public, of course, for tenants. They're even slower in their process to work through those evictions. And then lastly, there has been a proposal in December of 2023, which is referred to as the End Hedge Fund Control of American Homes Act of 2023, to make it illegal for large institutional investment firms to own single-family rentals, trying to keep available supply for home buyers high. This is likely something that will not pass as well, but is being talked about within the ranks of Congress. State taxes, just a quick snapshot here, so everyone can see the impact that state taxes have, where there are high tax rates relative to low tax rates. And given that the 1031 exchange enables that tax deferral, both at the federal and the state level, what you are seeing is a lot of migration from higher income tax states to lower income tax states. And yes, if your question is there a correlation between how aggressive a regulatory environment is and the tax rates? Absolutely. So if you look at the most hostile markets from a landlord-tenant standpoint compared to the friendliest markets in terms of whether they're supportive of property owners providing the service that they work hard to give, which is quality, reasonably affordable housing to tenants, those states in the Northeast and on the West Coast have both the higher tax rates and the aggressive regulatory environment. And we see a massive amount of capital moving to those Southern and Southeastern and Mid-Atlantic states where it's a much more balanced approach. So with all of that, key takeaways, commercial real estate cyclical. That is something that everyone should always have in the back of their mind. You don't want to be looking at, say, for instance, operations and property financials with a myopic view under a microscope. You want to look at it over a larger period of time. There are trends that they take some time to work through. They're not necessarily systemic issues. And by the time you're hearing, okay, there's momentum of, say, rents growing, then you want to have already been in that market at that point. Because by the time it makes the news and is distributed to the masses, that trend's already well in play. Even the best markets, Austin, Texas, Atlanta, Georgia, Dallas, Texas, they're impacted by these trends and macroeconomic conditions and interest rates and inflation and supply. Fortunately, as I mentioned, demand still very much strong, so we expect this to be short-term in nature. But there is a period of time where, as you're working through supply, it will adversely impact cash flow on properties. So what do you do knowing that? Well, you focus on high-quality properties, high-quality markets, effective managers. And there's always going to be, in periods of uncertainty, that flight to safety. Properties that are core, that are well located, that are well built, that are newer construction, they are much more resilient from a valuation standpoint than tertiary markets, than older construction, than heavy value add properties. In good times, there's more return potential with those properties, but our profile, our approach, the clients whom we work with, it is a flight to safety, a flight to quality. And then you can diversify. And diversification allows you to not have all your eggs in one basket. Different property types are impacted in different ways. So it enables you to then spread and have long-term lease properties, short duration lease properties, different markets in which you have exposure to, different tenant profiles, different industries, et cetera. And that can serve to reduce one's overall risk profile. And then don't forget about your, we'll call it non-financial objectives, estate planning, time management. For many property owners, time truly is the most finite resource that they have at 65, 75, 85 years old. And you can hold the course and continue to do what you're doing, but to what end? And are you going to eventually hand the problem over to a surviving spouse or the children who likely have no desire to continue to own and manage property? There are ways where we can take advantage of a sale exchange. You can be passive, you can have higher income, you can have a lower risk profile, and you can get your time back to enjoy those 10, 15, 20, 30 years that you have remaining, spending it how you please with who you please. So that's all we have, Jeff. We've got some frequently asked questions here that we can speak to. We have additional resources from an education standpoint that are all available on our AOA hub, re-transition.com/AOA. A couple upcoming webinars here, and we are always happy to have a conversation with AOA members to answer specific questions, learn more about their situation, provide some initial guidance, complimentary consultation, phone, Zoom, in person, any medium is fine. But appreciate the opportunity to share today.
Great. Thank you so much. I like the multifaceted approach to that. That was awesome. So thank you very much. And if you have a question or comment that you want to put into the chat, go ahead and put that in, and then we can give it to Austin, see what he thinks. And yeah, so I don't see any questions right now. So yeah, not really sure what to ask you. You said you had some questions that you prepared?
Yep, we can go back to some of our frequently asked questions here.
Let's take one of them, and that'll give people time to put a question in.
First question here is, what's likely to occur with interest rates in 2024? And the general consensus is that there will be anywhere from 1 to 3 rate drops that occur, rate cuts. Now, question is when, and I believe the Fed meeting that they're saying it's most likely to occur is the June Fed meeting. At the start of the year, people were expecting March. That's been pushed back because of some of the economic data that's come through. But we've already seen some movement on rates in the fall. Rates were coming down because the Fed doesn't necessarily have to actually do a rate cut in order to have that translate to a decline in, say, 5 and 10-year Treasury. Rates have climbed some over the last 4 weeks or so. From, I think, the 5-year Treasury was at about 4.15 and now is at 4.35. So about a 5% increase there in the 5-year Treasury, relative increase. But we'll probably see rates start to begin coming down in early summer, if not by fall, and then would expect a number of rate cuts to occur over, say, from the moment rate cuts begin to the next 12 months, maybe somewhere between 2 to 4 total rate cuts. How might interest rates impact property valuations in 2024? It all depends on what property type we're talking about. If you look at single family rentals, for instance, smaller single family rentals, lower cost single family rentals, very sensitive to interest rates. $1.5, $2.5, $5 million single families, your buyer profile does not care about interest rates. They don't care if it's a 4, I mean, they prefer a 3% loan, no question, but they're capable of buying the property with 3% loan or 7% loan. When we talk about investment properties, 2 to 4 unit properties, duplexes through fourplexes, very sensitive to interest rates. Larger commercial properties, 5 units and up, less sensitive, and we've seen there be stability in rates from about fall of last year, typically with conservative, or we'll call it moderate leverage, 50, 60% leverage, in the upper 5 to low 6% range. And if cap rates are right around there too, that's a place in which deals can get done. But remember, as soon as rates start to come down, property values will also be moving upward. So you know, you can buy or sell today in more of a stable detente market, if you will, or you can try to buy or sell with it moving. And if you're going to do an exchange, yes, you're selling into that perhaps slightly appreciated value, but you're also buying into that. So that's why the timing may not matter so much as addressing your other objectives.
Yeah, here we have a bunch of questions here that we can take. So Coral on YouTube, what are the tax implications of exiting an investment? So I don't know if I know you did more of a market presentation today, but so walk her through that as far as how much is she going to get taxed if she
Happy to. So let's assume this is an investment property in California. When you purchase an investment property, let's say you purchase a property for $500,000, just to use clean round numbers. Then over your period of ownership, you're taking depreciation each year. And that depreciation sheltering the income that you are earning from the property from being fully taxable. But the sum of that annual depreciation is called accumulated depreciation. That bucket of sales proceeds is going to be taxed at a different rate than the appreciation, the increase in value. So let's say you purchase a property for $500,000, you've depreciated it $200,000, which means you've probably owned that property for somewhere between 13 to 16 years. And let's say it appreciated to 1.1 million. Now, the way in which that 1.1 million is going to get taxed is your closing costs, let's call it 100,000, non-taxable. That's a deductible expense. Your remaining basis, say 300,000, which was your $500,000 purchase price less your $200,000 of accumulated depreciation, also not taxable. Now we're looking at that $200,000 bucket and the $500,000 of appreciation. The $200,000 bucket of accumulated depreciation is going to be taxed at 25% federally, plus likely 3.8% net investment income tax, plus your California state income tax. What's that going to translate to? Maybe high 30s, 38.8%, could be as high as 43.1%, depending on where someone falls.
Painful.
And then the capital gain bucket, that $500,000 is 20% federally, plus 3.8%, plus say your California state income tax at 9.9%. So that's the calculation methodology. You could just look at it and say, hey, if I've owned a property for over 15 years, let's say 35% tax on all the proceeds.
And that's if you're not in LA.
And are you referring to the luxury tax there?
Right. If it's over the mansion tax now, so that would be another one to consider if you're in LA, right? But
Yep.
Great question, Coral. And yeah.
And real quick, Jeff, I'm going to note, we have a tax liability calculator on our AOA hub.
That's right.
So if anyone wants to punch in their own inputs from a particular property, you'll get an idea as to what your approximate tax liability would be. So that's a great resource.
All right. Polaire on YouTube. Would you have a reason to do a 1031 exchange if you've just inherited a property and you won't have a capital gain hit because of the valuation at the time of death?
So if the property has stepped up in value and you just recently inherited it, then no, no, you shouldn't do an exchange. If you're going to sell the property, you should just sell the property, pay whatever likely small amount of tax that you would have, and then reinvest however you please. There's no need to add the complexity of the exchange into it. Some people who are inheriting property are not receiving a step up in basis, and that's possible because they've been gifted it or it was in a trust structure. Then you still may very want to continue or consider an exchange. But if there is a step up, then no.
All right. Lauren on YouTube, for a 1031 exchange, is there still a time limit on when you can acquire the replacement property?
Absolutely. Yep.
Yeah.
So 45 days following the date of sale to identify your replacement property, 180 days to complete the purchase of the investment property.
All right. Do your 1031s require 721 UPREIT at that 20-month period, or can I assume some have requirements and most stay as 1031s and can be exchanged into a new DST when the original DST sells?
Most are the traditional structure that you can continue to exchange into different properties down the road. Another DST, back into the local market, whatever you want, as long as it's held for business or investment purposes.
Right. And when they're deciding all that, they know that on the front end. So
Absolutely.
They can either avoid or get into that if that's what they're wanting, correct?
Exactly. That's
Yeah,
exactly
okay.
right.
Anwar Billy, it looks like on YouTube. Can you repeat the part about in good times value need properties are good, but in bad times it's better to shift towards newer properties?
What he may be referring to is tertiary markets are more volatile markets than those core larger urban areas. And when I say urban, I don't necessarily mean downtown. We're just talking populous urban centers. So the greater LA versus, say, for instance, Fresno, or maybe even a smaller Central Valley town like Fresno. You know, when times are good, those small markets end up having pretty strong appreciation curves, but they also come down far faster and further than the core markets do. And when we think about the journey, if you will, of owning and managing investment real estate, when you're younger, when you're in your 20s, 30s, maybe even 40s, you can invest in those tertiary markets, try to time the markets. You don't want to get stuck holding the hot potato when the market comes down, and potentially do quite well building a portfolio. But when you're in those later chapters, more retirement years and beyond, at that point, focusing on quality from a market standpoint, from a construction standpoint, vintage of the property types, that's what's going to serve to preserve your asset base and not sacrifice return potential. I mean, you're still going to have meaningful return potential, but with a substantially lower risk profile. And I think that's something that a lot of people, they assume and they understand within the context of, let's say, stock investments. You know, you don't invest in small cap tech companies when you're 65 for the majority of your portfolio. But we can apply that to investment real estate too, because we have ownership structures and vehicles like the Delaware Statutory Trust, where otherwise, you know, an owner may not have been able to access Austin, Texas with a Class A 2021 construction multifamily property. But by being able to exchange into owning a fractional interest of that property through a DST, you can. And so now let's build that into the strategy for an owner, and let's have a conversation about whether that makes sense for them.
All right. Looks like our last question here, Harvey. I have a triplex in Oakland. I should have done this 2 years ago. It's the regret there. Seems my property has lost significant value and will continue to do so. Should I wait for the slide to end or cut my losses? Any ideas?
I mean, on any individual property level question, it is going to depend in part on the nuance of that property. So we'd be happy to have a conversation about that and learn about what makes you think the property value will continue to decline. how far it has declined, whether there's a gain embedded in the property or not. But I think that without knowing the nuance of the property, then now can be a good time to sell, because if you are doing an exchange, then you're purchasing in that property at probably lower values before there ends up being appreciation over the coming years. But it is going to very much be a decision that needs to be made based off the individual and the individual property.
There you go. Well, hey, everybody, thank you for the good questions. And Austin, thank you so much for just sharing with us. I thought you did a great job. Next week, guys, we'll be having that a live stream about habitability. And then also, especially Fremont, Oakland, San Diego, we have some conferences, some seminars coming up in March, and also that AOA trade show. So I hope all of you can make it to at least one of those events. It's free for you as an AOA member, so take advantage of your membership there, and we'll see you next time.
Excellent. Thank you, Jeff.